Good morning. As the sun rises and cities come alive, millions of people across the country are starting their day, heading out to work, and contributing to the heartbeat of our nation. Let's talk about something that affects every single one of us: jobs. Whether you're clocking in at a factory, working from home, or running your own business, jobs are the thread that connects our daily lives. A steady job is more than just a paycheck. It's the foundation for our lives and dreams. It gives us the ability to support our families, plan for the future, and pursue our passions. For many, a job means stability, dignity, and the chance to build something better for the next generation. When the job market is strong, people feel confident making big decisions, like buying homes, starting families, or launching new businesses. This sense of security ripples out, encouraging spending and investment in our communities. A healthy job market fuels the entire economy, supporting local businesses and creating a cycle of growth. When people have work, they spend more, which helps shops, restaurants, and service providers thrive. This, in turn, creates even more jobs and opportunities. Job security brings peace of mind, letting us plan for the future and contribute to our communities. It allows us to volunteer, spend time with loved ones, and invest in the places we call home. But when the job market weakens, worry and uncertainty can quickly take over. People start to question their future, and the stress can affect not just individuals, but entire families and neighborhoods. That's why any sign of trouble in the job market gets our attention. It's not just a statistic, it's a real challenge for millions. The fear of layoffs or reduced hours can make it hard to focus on anything else. When leaders warn about a softening job market, it means fewer opportunities and more competition. People may have to take jobs they're overqualified for, or struggle to find work at all, which can be discouraging and stressful. Understanding these trends helps us prepare for what's next. By staying informed, we can make smarter choices about our careers, our savings, and our families' futures. The strength of our nation starts with the ability to find and keep a good job. It's what allows us to dream big, support one another, and keep our communities strong. A strong workforce means a strong America. When we invest in jobs, we invest in our future, our families, and the promise of opportunity for all. So when concerns arise, it's time for all of us to pay attention and get ready for change. Because in the end, jobs aren't just about work. They're about hope, resilience, and the American dream. Who's watching over our economy? The U.S. Federal Reserve, or the Fed, is our central bank. Its job keep prices stable and maximize employment, a tough balancing act. The Fed's decisions affect everything from mortgage rates to job availability. One key leader is Vice Chair Philip Jefferson, a respected economist with deep experience. When Jefferson speaks, markets and policymakers listen. The Fed's main tool is setting the federal funds rate, which influences borrowing costs across the economy. By raising or lowering this rate, the Fed can slow down or speed up economic activity. Jefferson helps guide these crucial decisions, analyzing data and debating the best path forward. His recent comments give us a direct look at the challenges and opportunities ahead. That's why what he says matters to all of us. In late September 2025, Philip Jefferson, the Vice Chair of the Federal Reserve, issued a warning that caught the attention of economists and everyday Americans alike. He pointed out that the U.S. job market, which had been a pillar of strength through recent economic turbulence, is now starting to show signs of stress and vulnerability. Jefferson isn't predicting an immediate disaster, but he's urging both caution and proactive measures. He wants leaders and policymakers to recognize the early warning signs before they become bigger problems. A softening job market means companies are hiring more slowly, job openings are shrinking, and competition for available positions is getting tougher. The days of plentiful opportunities may be fading, at least for now. For workers, this could translate into fewer raises, fewer promotions, and a general sense of uncertainty about the future. For job seekers, it means a more challenging search, with more rejections and longer waits between interviews. The path to new employment is becoming steeper. Jefferson's concern signals a significant shift in the Federal Reserve's focus, from its recent battle against high inflation to a renewed emphasis on protecting jobs and supporting employment. With economic growth slowing, there's less momentum to create new jobs, and some industries are already feeling the pinch as demand cools and investments pause. Jefferson's warning is more than just words. It's a call for the Fed to act quickly and decisively to support employment and prevent further deterioration in the job market. This isn't just economic theory. It's about real people, real families, and the stability of communities across the country. When jobs are at risk, so are livelihoods and futures. When the Fed vice chair raises concerns, it's a clear sign that the economic winds may be shifting, and that everyone, from Wall Street to Main Street, should take notice. Policymakers, business leaders, and workers all need to pay close attention and be ready to adapt. The choices made now could shape the job market for years to come. Economic stability isn't automatic. It requires constant vigilance, careful analysis, and decisive action from those in power. Jefferson's words are a heads-up for everyone, a reminder that the job market's health can change quickly, and that preparation is key. The job market's health is never guaranteed, and in times like these, staying informed and ready to respond is more important than ever. In response to growing concerns about the job market and signs of a slowing economy, the Federal Reserve recently made a significant decision. It cut its key interest rate by a quarter point. This is the first time the Fed has lowered rates since December 2024, marking a notable shift in its approach to supporting economic growth and stability. The move, strongly supported by Vice Chair Jefferson and other Fed officials, is designed to give the economy a boost and help prevent further weakness in the job market. By lowering rates, the Fed hopes to encourage more spending and investment, which can help businesses grow and create new jobs. When interest rates go down, it becomes less expensive for families to borrow money for things like homes, cars, or education. Businesses also benefit, as they can access cheaper loans to expand operations, invest in new equipment, or hire more workers. This means that mortgages, car loans, and business investments become more affordable for many Americans. As a result, we could see more people buying homes, more cars being sold, and more construction projects breaking ground, all of which can help create jobs and strengthen local communities. But the Fed faces a delicate balancing act. While it wants to support job growth and economic activity, it must also keep a close eye on inflation. If prices rise too quickly, it can hurt consumers and undermine the economy's long-term health. The Fed's challenge is to stimulate growth without letting inflation get out of control. By cutting rates now, the Fed is providing a cushion for the economy, helping businesses and workers weather uncertainty. This move is meant to keep the economy resilient, even as global and domestic challenges persist. Ultimately, the Fed's goal is to achieve what economists call a soft landing, slowing inflation to manageable levels without triggering a recession or widespread job losses. It's a careful process that requires constant monitoring and adjustment. If economic conditions change, the Fed has signaled it's ready to act again, possibly cutting rates further to support growth. This flexibility shows their commitment to responding quickly to new data and challenges. For anyone feeling anxious about the future of the economy, these actions are a clear sign that the Fed is actively working to address risks and protect the financial well-being of American families and businesses. By taking these steps, the Federal Reserve is striving to keep the economic engine running smoothly, safeguard American jobs, and ensure a stable future for everyone. To understand the Fed's actions, we need to talk about inflation. Inflation is the rise in prices over time, which erodes your money's value. The Fed aims for about 2% inflation, a level that keeps the economy healthy. Too much inflation hurts everyone, making it harder to afford basics and save for the future. That's why the Fed raised rates in recent years, to cool down prices. Now, with inflation easing, the Fed faces a new challenge: protecting jobs. Balancing inflation and employment is a constant tightrope walk. The tools to fight one problem can create another. The Fed faces a tough trade-off: high inflation or rising unemployment. High inflation quietly erodes everyone's purchasing power, especially hurting those on fixed incomes. Job loss, on the other hand, is a sudden crisis for families. Lost income, tough choices, and stress. The Fed's challenge, as Jefferson notes, is to balance these risks. Raising rates too much can slow the economy and cost jobs. Cutting rates too soon can let inflation rise again. The recent rate cut shows the Fed is shifting focus to support jobs. It's a calculated move to find middle ground. There's no perfect solution, just careful judgment based on data. The Fed's goal: minimize harm and steer the economy toward stability. Every decision has trade-offs. The stakes are high for everyone. The Fed doesn't operate alone. Other factors shape the economy too. One big source of uncertainty: government policies, especially trade and tariffs. Tariffs can raise prices for businesses and consumers, making the Fed's job harder. They're meant to protect U.S. jobs, but can also trigger retaliation and hurt exporters. Jefferson notes that the effects of these policies are unpredictable and still unfolding. This uncertainty makes economic forecasting tough. The Fed must stay flexible, watching data closely and adjusting as needed. It's a reminder: the Fed is just one player in a complex global economy. Policy shifts and global events all shape our economic reality. So, what does all this mean for you? If you're job hunting, expect a tougher market. Fewer openings, more competition. Make your resume stand out, network, and be persistent. If you're employed, focus on growing your skills and proving your value. Lower interest rates might help your finances. Consider consolidating debt or building savings. Don't panic, but do review your budget, save more, and be strategic about your career. Understanding these trends empowers you to make smarter decisions. Take control where you can and be ready for whatever comes next. As we look ahead, the Fed's message is clear: stay alert and be prepared. The focus is shifting from fighting inflation to protecting jobs, with more rate cuts possible if needed. For all of us, this is a time for smart preparation, not fear. Build up emergency savings. 3 to 6 months of expenses is ideal. Review your budget and pay down high-interest debt. Invest in yourself, update your resume, reconnect with your network, and learn new skills. The American economy is resilient, and so are we. Stay informed, be proactive, and focus on what you can control. Warnings from leaders like Jefferson are meant to prepare us, not scare us. By taking sensible steps, we can face the future with confidence. We've weathered tough times before, and we'll do it again.